Monday morning, folks, and welcome to a brand new episode of FinMet Mondays. Sunil, we had a little bit of a lackluster week last week. Nothing much. We had the Thanksgiving and Black Friday holidays, but yet a $20 increase in gold from 1980 to somewhere around 2000. It's right at the 2000 mark. One of the main things was the Fed release of the Fed minutes as well from their November 1st meeting that they had recently. But net, what are your takeaways that our listeners should be aware of?
I mean, I should say that we're certainly surprised. Last couple of weeks, gold has been stronger than we would have expected. The gold markets themselves have seen lesser physical demand, and so the physical markets are at a discount. So really, if you peel the onion and look at deeper inside, it's really to do with the gold market's price bullishness is to do with dollar weakness. So I think the market believes that the hikes are pretty much done, even though the Fed is making a brave face and saying they'll be strict and they'll be strongly act against inflation. I think right now the market does believe that the Fed is done, so therefore further dollar rate increases are not going to happen, and therefore the dollar has become weaker against most currencies, and similarly against gold, it's become weaker and dollar has moved. The gold price has moved higher.
Any takeaways from the Fed minutes specifically? So, I think
Yeah,
one of the questions I've gotten is, what is the Fed still looking for as a stopping point of, okay, this is the time now we will give out a notice saying this is the end. We're not going to continue maintaining a hawkish stance.
I think they don't want to say anything. I think they don't want to say that they'll stop because the market, they're worried that the market is going to rush towards rate declines. So they
Mm,
don't want to start the discussion about declines, right?
mm,
And about flattening. They're saying, look, the risk is on the upside. They're trying to make the market believe that they're still going to be quite hawkish.
mm.
I think they'd like to see consistently low inflation before that talk changes. So that's why you're seeing, um, you know, what the Fed is saying is one thing, but what the market believes is that, oh, we're done. But given the fact that we're at these 2000 levels, tell me from a technical point of view where we're going from here, please.
Like we discussed, we did see a $20 run up in gold, and we are currently at the 2010 resistance. This red line right here. Now, I don't think gold has the runway to climb above this 2010 resistance. There are several reasons for it. Number one, you do see an exhaustion in how the metals price action has been moving as it is progressing upwards. Typically, when a new uptrend is created, it has a huge fundamental underlying support that backs it. But at the moment, currently, we don't have anything going for it. Just from a purely fundamental standpoint. From a technical standpoint as well, you do see a slowdown in how that ascent is actually being created on the technical charts. We are seeing that up till 2000 there is definitely run up and there is buying support, but as you hit that 2000 mark, you're seeing more profit booking and you're seeing more selling pressure overcome that buying pressure. So at the moment there's not a lot of momentum for gold, which is why I think this 2010 resistance is likely going to act as a barrier. The range for next week is going to be somewhere between 2010 to below the 1987. Where below the 1987 remains to be seen. Now, let's come to some of the economic data points that might determine this, right? Some of the main points are we have the GDP growth rate estimate number. These are early indicators of, okay, how is the market reacting to the interest rates? But more interestingly, you have the PCE price index, which is the Fed's preferred measure of inflation. Now, we already saw CPI inflation come lower for October. It's time for PCE to confirm the same trend if gold is going to have a run up above. If you're again going to see a sticky and a hotter PCE reading, you're going to have the Fed again come and say, oh, we're not really sure about inflation. Inflation is still very sticky. We're going to remain hawkish or keep rates elevated. So that's how the talk is going to continue in each of these scenarios, basically. But all in all, these are the two key data points, mainly on Thursday, that will be releasing, that will determine the majority of the movement for next week. Well, thanks, Neil. I think that covers our outlook for next week. Let's see how the markets play out. But till then, thank you and goodbye.